Okay, so all right. Hey everyone, my name is Namit, and today I will be your host for our second episode of Economics Explained COVID-19. I'm joined by Katrina and Nina and Dev, who are also the members of the UEC executive team, and Dev is, of course, the president. And they will be assisting me in case of any technical issues. Thank you and shout out to everyone and anyone who's today, who came to today's live session. We really appreciate you, and we hope to see you in the future episodes as well. Okay, so in today's episode, we will be investigating fluctuations in the financial market due to the COVID-19 in the past few months. The discussion will include topics such as stock analysis for different sectors, what were the key elements that plummeted the trading industry during the pandemic, and much more. Today, we have Professor Marius Zoikin from University of Toronto, Mississauga as our guest speaker. So without further ado, I would like Professor Zoikin to give us some insights about the topic.
Right. Thanks so much. Thanks for having me here. This is a great initiative. We always need to learn more about the world, about economics, and about the market in this unique context. So the link for the slides is in the chat. I hope you can all see it. And if you click on it, you'll just see the presentation live, or you can watch it on the share screen. So I entitled the presentation for today, "Is This Time Different? Markets in the Age of the Pandemic?" And this is a callback to a famous book after the 2007 crisis, because we like to think, we know that crises repeat each other in financial markets. There's always going to be a next crash, but they're never the same. They're never from the same cause. They're never identical. So what can we learn from how markets responded to COVID, and how does it relate to what we've seen in the past? So if we're actually looking at markets, right, throughout from February to August, markets recovered extremely fast, right? So I got this picture from the Wall Street Journal, in which I basically look at bear markets throughout history. And this particular bear market, as deep as it was, and it was as deep or deeper than previous crashes, it only lasted 126 days, right? From the beginning of the crash, which I think was around mid-March, up until the Dow Jones got back to the level before the crash, right? And if we compare it to previous crashes, like it was a crash in 66, 67, that just took less than a year, 310 days. The 87 crash took about more than a year, right? 485 days. So this, if you look at the market, it seemed to have rebounded pretty fast. And this is a graph I made from Thomson Reuters. You can see, right, there's nothing happening. January, February, COVID was going on in Asia, but it hadn't yet become a full-blown pandemic. Then we go to March, cases start to skyrocket in North America. The indices, the S&P 500 drops about 30%. NASDAQ drops about 20%, right? And there you see here huge volumes, huge trading interest, uncertainty about the fundamentals. And then, it gets back to the level of what it used to be incredibly fast. So if you look at yearly returns or year-to-date returns, from January to October 2020, S&P is up 7%, which is actually not a bad yearly return in some sense. And the NASDAQ is up 30%, right? So if you put money in the tech sector, if you put money in NASDAQ in the beginning of the year, you would have gained basically a third back, right? So this is puzzling, because the reason why you guys invited me here today, always talk about the financial crisis. And if you look at these pictures, you would think, okay, there's probably no financial crisis to talk about. So let's compare this with what happened in the previous crisis that some of you might remember, between 2008 and 2010. So there's now, the rock bottom was about minus 50 minus 55% from the previous high. But then it really took 5 years, right? Not 100 something days, but 5 years to get back at the pre-level crisis, pre-crisis levels of the S&P 500. So that's quite a different time scale that we're operating. And this points to the fact that indeed these crises are very, very different in nature, and obviously we approach them differently. So what happened in 2008, 2010? Well, that was a crisis that really started from the financial sector, right? And from the financial sector, it moved towards the real economy. So fundamentally, the problem was over leveraging. In 2008, the credit was cheap, right? Like it is now. Everybody was borrowing, right? The households were borrowing above the means. They were leading to those so-called ninja loans, like no income, no job, nor assets. The banks were deciding, okay, this is a great era of deregulation. They started getting more and more into financial markets, away from their traditional loan deposit type of business, and shifted their funding structure towards more and more short-term overnight loans or repos. And I mentioned, right, this was a period of under-regulation because regulators felt, okay, everything is good with the market, but in reality, they underestimated systemic risk. They underestimated how connected the banks have become, and how much risk was hidden under the surface, and how much was covered away by borrowing more and more. Now, in the pandemic crisis, this is a real shock, right? This is not banks being greedy or the financial system being fundamentally eroded by under-regulation. This is a real economy shock. There is massive unemployment, right? And I took this from CBC News. Unemployment skyrocketed between January and April. There are frozen economic sectors, right? Airlines are basically don't have any customers. They have to operate at a loss. Hotel Airbnbs are disrupted. But at the same time, there are economic opportunities for some companies, right? Especially for tech-savvy companies that can actually take advantage of work from home. For example, I took a snippet from Financial Times. Amazon doubled its quarterly profit, right? Because everybody wants to buy things online, right? Because there are no more shops. So in some sense, this has been a redistribution, and that's why we see NASDAQ being up 30%. Things that are into tech could take advantage, could scale up, and basically sort of substitute in some sense for the companies that went bust. Okay, so far we've seen there has been a distribution. Market is up. Is everything good? Well, not really, because the real crisis of COVID actually starts to spill over to the financial sector. So here I took a snippet. There is, and New York University has a very interesting data set called the VLab, the Volatility Lab, and they measured the systemic risk, basically a heat map of how much risk the financial sector is taking. And in the US, right, this is 2008, 2009, that's when the systemic risk was skyrocketing. And that's when the probability of a crisis was basically 100% because we were in a crisis. But since then, systemic risk has started to drop slowly. The blue line here is the risk-taking capacity of the economy. So you see that the systemic risk stayed for most parts below the risk-taking capacity of the economy. So everything is good, but now we're actually skyrocketing again. So according to this heat map, the probability of having a financial crisis in the US is up to 80%. So it doesn't seem like the stock market's rebound tells the whole story. If you look in Canada, it's the same, right? The big peak of the financial crisis in systemic risk, then gradually going down, and 2020 comes. a spike in risks, right? So there are a few channels through which this kind of crisis spillovers from the real economy to the financial market. A lot of the banks have made loans to perhaps small or medium enterprises that cannot really access the equity market. And now with a lot of companies going bust, some of these ones will be non-performing. The government is actually trying to ease the impact of the crisis by being more forbearant, by deferring loan payments, by allowing people to push back their loans, their credit for longer, and that's eventually going to hurt the financial sector. And it's injecting money into the economy, and it's basically substituting away the intermediation channel that banks are doing. So for every company that's not financed directly on the market, directly in the equity market, so for everybody that's not an Amazon or a Facebook of this world and have to go through banks, the government sort of helps them, but at the same time will hurt the health of the bank. So we might end up with another sort of crisis in the financial sector, and that which will ripple through in the future, even after the COVID is ended. Now, we learned a lot from the previous crisis, right? So part of the recovery is because the US also, the Federal Reserve and the Bank of Canada to some extent are being much more proactive into intervening directly into markets, right? So we have quantitative easing, like the same way we had in 2010, but we have a steroids version. We have a much more forceful intervention into the markets. So the US Federal Reserve, they relaxed regulatory requirement for banks. They dropped the reference rate, the interest rate from 1.75% to 0.25%. So that's quite a drop. But something that they didn't do in 2010 and they're doing now, they created two types of corporate credit facility, right? So rather than using the banking system as an intermediation channel, they have two new instruments to intervene directly to the real economy. They can lend directly to corporations. That's what's called the primary market corporate credit facility. And this has been quite controversial. They might actually go on the secondary market and buy corporate bonds and bond ETFs, which is called the secondary market corporate credit facilities. And a lot of equity market commentators were saying, well, the Fed now acts as a mutual fund, right? Because they have to select which ETFs to buy, which bonds to buy, and it's unclear, what kind of criteria they will have. But the Fed was much faster and much more forceful in intervening in the real economy than in the 2008-2010 crisis. What effect this will have on the banking sector, that remains to be seen. That's still quite a bit unclear. So we saw the market going up. We saw that the Fed is intervening quite a lot. So are we reading too much in the market recovery? Because the systemic risk parts show that we're not out of the woods, even if the market has recovered. But if you look at Donald Trump's tweets, you think everything is good, right? In 4 days, we had the biggest stock market increase since 1974. So there seems to be quite a bit of the optimism. People tend to read too much into how the market is going, or that's what I'm going to try to convince you of. And I'm going to ask two questions in the rest of the presentation. What is the market, and who is the market? So what is currently the market? When we look at S&P 500, when we look at NASDAQ, we don't really see the real economy, and that's a problem. There is a great disconnect between Wall Street, between finance and mainstream, where the actual firms are trying to produce. If you look at the top five, right, they really took advantage, not necessarily in a bad way, but they really profited from whatever was going on, and by the fact that a lot of the economy has moved digital. Apple is up 60%, 58% since the beginning of the year. Amazon is up 75%. Facebook 26%, Microsoft 34%, Alphabet 10%. So now these five companies, the so-called FANGs, actually have substituted themselves from the market, right? They make up for 25% of the S&P 500. So when you look at the performance of an index like the spider, what you're seeing is not how the economy is doing. You're seeing essentially how these five companies are doing. And because everybody is using Amazon, you'll think, well, the economy is doing great. But in fact, their corporate profits are of a select handful of economies that are doing well. So in this crisis, William Ackman was a hedge fund manager at Pershing Square Capital Management, said, okay, the stock market has a survivorship bias. It's only the biggest, the strongest companies. And he claimed that if you're a stock market of private small business, mom and pop shops, real Main Street type of economic activity, that will be down 50% or more. So whenever we're looking at the market, we have to realize that the market is doesn't overlap with the economy. And the more time it passes and the more these companies are growing, because an index like the S&P 500 is valuated, the more these companies are going to identify themselves with the economy. So to see what the markets really think of the economy, we have to be a little bit more savvy than just looking at the index. So for example, what are we doing if we look at growth stocks that have a high price to earning or a low book to market ratio? The growth stocks are supposed to react less to business cycles because they have, for example, less fixed assets, right? And companies such as Amazon or Apple, they would fall into this category. And value stocks, the stocks that have a low price to earning ratio, they are more connected to the real economy, right? They typically have more employees, they typically have factories that they need to operate, so they're more sensitive to the business cycle. So if you look how growth stocks perform relative to value stocks, you can see that a high minus low portfolio has typically underperformed, right? The blue line here is the market. So the market dropped and then went back up again. So that's the nice story. That's the V-shaped recovery that people like us to see. But the high minus low portfolio, which is essentially the value minus the growth stocks, kept going down. So investors believe that value stocks are not doing so well. And that means that investors are not seeing the business cycle moving back to growth anytime soon. So all this growth here is driven by growth stocks, which are actually less sensitive to the business cycle. They're essentially the tech companies, right? So, so far, when we see the market going up, is literally a couple of companies that are less likely to be sensitive to business cycle and are actually particularly well positioned to take advantage of the transition from face to face to digital. Another topic that I find particularly interesting, since my own research is in equity markets, is the shift that the pandemic brought in who is the market. Who are the investors? Because that seems to switch. I'm going to show you a couple of interesting graphs. The first pattern is that we have a lot more retail trading than it used to be, right? In equities, retail trading increased by 52% in the second quarter of 2020, in options by 15%, right? Before the pandemic started, like retail trading, like me and you, were making up 9% of the market. Now it's up to 13%, right? So that's like a 40% increase in total. And this has caught the attention of the market, right? You see this title here from Bloomberg: "Bored day traders locked at home are not obsessed with options." So there has been a lot more risk taking and a lot of more FOMO, a lot more fear of missing out. Everybody says, well, the market has bottomed out. I want to trade. I want to be the person that buys at the bottom. And this has been sort of helped by a couple of advances in the industry of trading and the way that retail trading is marketed. One such innovation is fractional shares. Before you could buy one stock of Amazon. Amazon, it's $3,000. It's almost impossible if you only have $1,000 to invest. You cannot really buy Amazon. But now brokerages are offering fractional shares, so you can buy 0.00000 free shares for 1 cent. So that increased the appetite for retail trading, and also they slash trading commission. Okay, so now you actually don't have to pay to trade for most discount brokerages like TD Ameritrade in the US, but in Canada, stuff like Wealthsimple, Interactive Brokers. So you see this and you think, okay, I trade for Wealthsimple or I trade for Robinhood. How do the brokers make money? And the way they make money is by taking your orders, selling them to a big firm like Citadel, to high frequency, an algo trader who's actually using your trades to sort of trade in front of you. So you're actually not getting the best prices. So the pandemic created bored investors. Bored investors are going in droves to the market, and they're essentially getting suboptimal prices because your free brokerage is selling the order to somebody else. There's also been a human aspect to the increase in retail trading. People are, again, locked at home. They're putting a lot of money. They're taking a lot of risks, and that can drive tragic effects, like the 20-year-old Robinhood customer who essentially made an option trade. He saw a negative balance of $730,000, which was temporary. It was like a one-day margin account mismatch, and unfortunately committed suicide because he didn't really understand what was going on with his account, right? And this gamification makes people trade more, makes people play more, but they play with their life savings. So I have here a tweet by fellow professor Lisa Kramer, who is drawing attention that the way Robinhood is marketing trading to investors, promoting frequent trading is actually making them take too many risks as opposed to what they currently should. And they're very funny things. There's really a wide west. One interesting case is the Hertz bankruptcy. I'm not sure how many of you heard of it. Hertz is was basically a car rental business. There are not a lot of car rentals in the COVID world. So this company filed for bankruptcy in May. But then something crazy happened. Retail investors saw Hertz is a penny stock, and they started pumping it, right? Shares surged more than 800% since the company declared bankruptcy. And you can see that a lot of this retail trading came from Robinhood users. So they were essentially trading a very old-fashioned brick-and-mortar company. They were basically trying to pumping up like a cryptocurrency. So the Hertz people are not stupid, and what they did, they said, okay, if there's so much interest and they're willing to prop up our shares, even though we're a bankrupt stock, let's do a public offering. Let's sell 1 billion more worth of stocks. And the stocks were worthless because the company was filing for bankruptcy, right? And even Hertz admitted, where we expect you to lose all your money, but if you're that bored that you want to invest in us, if you really want to take these risks, why not? So you see, there's this interesting psychology of traders that really feel like, Hertz is going down. Why not trade? Look, shares surge more than 800%. We want a piece of that action. We want to make 10 times the amount of money we put in. And they are less savvy about bankruptcy law, or the fact that they're essentially buying a product that's worthless, and the companies are callous enough to double down on this. And in the end, the SEC blocked the deal, said Hertz is not allowed to sell stock essentially for a bankrupt company. But those were all things that were going on during the pandemic. So the nature of the market changed a lot. And if you zoom into these stocks, you see these huge disparities, like 900% return on a bankrupt stock. So to close of the presentation, right, we're moving to a work from home financial market. And the question is, well, is this feasible? And the answer is yes, with a number of caveats, right? So here I'm going to talk about two issues that I talked before to the press. Trading hubs actually make surveillance easier. So working from home is bad for insider trading, right? Because before, everybody all in a bank, you would work at the CIBC or the TD trading floor. Everybody would go there, and they would essentially keep an eye on each other, right? You couldn't receive a phone call from an insider of the company and say, hey, just buy 1,000 shares worth of stock X, because your phone would be recorded, there would be cameras, your boss would be around, you will be harder pressed to engage in any shady deals. And in the work from home world, you can use your personal phone and you can do that. And it's very hard to detect it. It's very hard to detect insider trading. It's very hard to detect shady deals if you're working from home and if you can basically take phone calls from everywhere. And that's a problem for securities exchanges. The technology is there. The human incentives might be slightly different. And there's also a question of the human touch, right? Because it's hard, like in the good old days before COVID, being listed on an exchange was a measure of corporate success. Just going there physically at the NYC, having the opening ceremony on the trading floor, used to be a signal to the market that you've done it. And nowadays, this sort of like the human touch of physically being on the floor, the CEO shaking the hand of the NYC president, that's sort of disappearing. So it's much less important for companies to signal in a virtual world that they're listed. All right. So to conclude, one market that did not slow down in this, because we talked about equities, right, for basically the entire talk. One market that did not slow down is the real estate market, because what COVID brought is a need for space, right? So I took some sort of like data from the GTA, and if you look here, the average price on the MLS went up about 8 to 9% from September last year to September this year, and the number of sales went up 40%, right? And that's sort of a market that went up in a more fundamental reason, with people sort of migrating away from the cores of the city, from downtown to the suburbs, right? Because if you look at the number of sales, you see that mostly the increase comes from detached, semi-detached townhouses, less from condos. So this is a market that's moving up through natural pressure. Okay, so that's what I had for today. Thank you. Stay safe, and I'm ready to take any questions.
Yeah, thank you so much, Professor. That was very informative presentation that you gave right now. And I would like to ask everyone if anyone has any questions to ask the professor right now. They can go ahead and unmute themselves if they can, or they can ask it in the chat.
Professor, I just have one question. My Wi-Fi might cut off, so I apologize if I cut off. But yeah, so one of the questions that I have for you, I believe it was either CNN or MSNBC. They made a report that that of course, because of the economic shutdowns in the United States, the poorest people in the United States have been hit the hardest, and of course, they do not have as much tangible and intangible assets as the wealthiest 1%. So the massive rebounds that we're seeing in the market, how do you think that would affect wealth inequality within the major OECD countries like the United States or Canada? And are there any policy measures that you think the government can take to reduce wealth inequality?
Oh, that's a very good question. So I do believe that the crisis would deepen inequalities. You know, if you look at the market, right, and then the thing that I talked about is really inequalities between firms, right? Like companies that scale well with technology are likely to do better than mom and pop firms who do not. And you know, if you zoom in, the same is true on a human level. So people who already have they were lucky enough to have some capital or to have the sort of already built an education or human capital, they are likely to weather better the storm, right? So in the sense that there are groups that are structurally disadvantaged from accessing education and from accessing technology. For them, is going to be much harder to bounce back up. Now, what could the government do that is not doing? I think what they're doing in terms of you know, palliative measures in the short run, like the CERB in Canada, like providing this kind of bridge loans, those are very good, and those could attenuate the effect. In the long run, if we want to sort of foolproof our economy to this kind of shocks, investing more in education, making, you know, free education for everyone, and investing more in the access to technology. Like I think in Europe, many countries have used their education budget, for example, to give laptops to all students like age 7 to 18, training instructors to be more digitally proficient, and you know, researching ways how to improve this kind of online transition. That would be good. That would be the best.
Thank you. And I believe there's a question in the comments for you.
Hi, Professor. Do you think it's a good time to invest in real estate investment trusts, since real estate doesn't seem to be slowing down? Well, let me check what was XRE doing, because I had that idea at some point, but no. The problem with real estate investment trusts is that most of the ETFs that you're seeing, right, they're essentially built on commercial rather than residential space. So commercial space prices are actually not going up, right? People want to move out, so the demand for residential is up, but there's actually much less need for office space or for retail space. So that effect seems to dominate because a lot of these ETFs load heavily on commercial. So, you know, just to tell you, know, people make mistakes all the time. I bought XRE at the beginning of the crisis when it was $21, thinking that, you know, that might happen. Now it's 14, and then I realized that actually it's pretty much all commercial, and it hasn't gone up since. So if you can find something that's residential purely and in a good suburban area outside a big city, like GTA minus Toronto, then that would be a good idea perhaps. But pay attention to the actual composition of the ETF. I hope this sort of helps.
Okay, Professor, I had a question. I just wanted to know more about like the stocks in insurance sector during this pandemic, and how were they doing related to the market that was, the financial market as it plummeted and everything, and how there was a pandemic and like people realized that they need like that's what I think. Like people would think that they need more insurance policies. Like they would rather pay more for the insurance policies just in case, because like there's a certainty of like dying because this is such a disease. So how did the insurance companies do during these 4 or 5 months of the pandemic? Did they go up in like stocks, or did they like plummeted as well? Or how did the people how did the investing of people react to this particular sector?
Oh, that I actually don't know. Do you have any example of a stock?
Not
Because I
really.
can look sort of like at financials, right? But financials do much more than insurance.
Okay.
So I think financials follow typically the same trend as the market overall.
Mm-hmm.
Now there could be more demand for insurance for sure, but at the same time, this is a systematic type of risk. And insurance companies are very good at dealing with idiosyncratic risk, right? So let's take a disease like cancer. Cancer is not a pandemic. I mean, it is a pandemic in some sense, but it's not a global phenomenon that just emerged, right? So you take a basket of 1 million people or 10,000 people, and some of them will get a disease, some of them will not. In the context of the pandemic, if you expect that there is a shock to the entire society, I'm not sure to what extent this could be reasonably insured.
Okay.
So you have to take into account the fact that this is like a massive earthquake that's wiping out everyone at the same time. Yeah.
Are there any further questions? Sure.
Yes, I have another question. This one is, I'm going to be specifically referencing the United Kingdom and their capital markets, but I read a book, an article about the UK, and before the 2008 crisis, the importance of the financial sector in providing tax revenues to their version of the CRA. I think it provided, from 2000, they provided from 10% of total revenues to close to 30 to 40% of their revenues before the onset of the 2008 crisis. So when these banks started when they started collapsing, of course, the British government started losing immense amounts of money from the financial services sector. So then now what we're seeing in the economy is like a lot of money has flown from the real economy into capital markets, into the stock markets, growing the importance of financial institutions. And increasing their share of, or what I will presume to be like increasing their share of tax revenue to the state. So the question that I have is, how do you think that this massive rapid recovery of the financial markets will affect the balance sheets of governments, and how do you think this will impact the size of financial institutions? And do you think this rhetoric of breaking up the big banks will start to get more intense since they have taken a more prominent role in all of our lives and in the market?
All right, that's a lot to unpack. So
it's a lot.
Yeah. First off, like Europe has, perhaps UK to a lesser extent, but Europe in general has a very different approach to investment than the US. So typically, people in Europe, even before the crisis, they would not be so crazy about the stock market. They would put most of the money in the banks. So if you see a shift there from banks to the stock market, that could be because, unlike US, they were not very active in the stock market to begin with. In North America, in Canada and the US, I don't think we've seen a massive shift after the crisis. There are going to be tax effects for sure, but the tax effects are going to be primarily because the government itself is sort of deferring payments, right? It's sort of saying, well, the bank revenue is less important in the short run, than there is the well-being of, the society or the real sector, we're going to catch up afterwards, because if we don't allow these Main Street businesses to survive, then we're going to have unemployment at the best, but then social unrest. So it's better to insure ourselves. So there's probably going to be less income coming from banks, that's for sure. There are profits, or there are profits in the corporate sector, like companies like Amazon, like Facebook, that the massive growth, the massive rebound on the stock market. As I think it was on one of the slides, Amazon doubled its profits. They could sort of pump this revenue into the taxes. The problem is that corporates typically are very good at hiding those taxes, or doing a lot of arrangements so that actually they don't have to pay that much. So that could be a problem. This sort of disintermediation, like the channel of the bank. But I think that was particularly important in Europe back, and especially before 2008, 2010, rather than it is in North America. I'm not sure if that fully answers your.
Oh no, I think it answers that. Thank you.
Yeah, thank you.
Are there any other questions, Katrina? Do you have
Actually, yeah, I have a question. So you mentioned that the real estate market is something that could be watched during COVID, and obviously the technology sector is a very important sector to watch during this time. But I was wondering if there are any other sectors that investors should be looking out for. Like, I was reading online that actually the energy sector might be something that might be changing, because people might be leaning towards more cleaner energy sources during COVID-19, just because the demand for energy has risen so much. We might be looking to a more greener, more efficient use of energy, thus investing in these types of businesses.
That could be, but has the demand for energy increased that much? Because I'm thinking with less commuting, there might actually be a lower demand for gas, for example.
I assume so. I don't know, like the article that I read said that the demand was actually going up for energy, maybe because of technologies like evolving more throughout COVID. But do you think that would be a sector that would be looked out for during this time, or if there's any other sectors that we should be looking out for?
I think the most sector in spotlight is technology. Energy, it's an interesting sector to think about, because on the one hand you have this the fact that people are working from home, right? So that means that gas demand is down, right? Oil prices have went down. Perhaps in this context, with oil prices going down, people are less interested in sort of investing more in oil. Like, you see what kind of problems the drop in oil price has created in Alberta, for example. So the profitability, or the sort of profitability of building an entire economy, or a regional or country economy in the Middle East on the oil sector, is probably threatened at this stage. But that to me comes from lower demand rather than higher. Also, in a world of lower demand, in the world of working from home, it's easier to sort of generate the amount of electricity from clean sources. Because if you don't have to power that many cars, if you don't have to power that many factories anymore, if everybody's at home, the sun attracting energy, there could be this potential. But this was a trend that was going on for years, right? They have this ESG Etfs, right? The environmental and sustainability Etfs, which allow you to invest in this kind of projects, and they have been performing quite well. So it's definitely something to look at, particularly because of the drop in oil prices. And that's another thing I haven't talked a lot about, like the commodities, right? I remember at some point during the crisis, oil prices went negative.
Yeah.
Right? So
the crude
people were actually receiving money to stock to store oil if they
yeah.
actually wanted delivery. So in that context, right, it's no longer that profitable. If your economy is based on oil, you can be essentially screwed if you don't diversify. So that makes the case for diversification.
Are there any other further questions from anyone in the session right now? Okay. From the surveys that we've done, Professor, the responses that we've gotten from our students, we have some questions for you regarding this topic. So the first question is, how will COVID-19 impact most people's investment portfolios and strategies moving forward in the future?
How will it or how should it?
How will it impact?
Look, I think for retail persons, for retail investors, right? Like, if I am to sort of give an advice to everyone that's in the room, staying passive is probably the best thing to do, right? So my advice is still, go invest in the market, invest relatively broadly across asset classes, equities, have an equity ETF, a bond ETF, perhaps a real estate ETF, right? Or perhaps some commodities. The way it did impact the investment style, we saw on the slides, right? There's been a huge emergence in retail trading, a lot more risk taking, a lot of strategies that fundamentally don't make sense, like really pumping up a bankrupt company for the sake of pumping up a bankrupt company. And this over leveraging in the context where brokerages are enticing you, right? They're offering you the candy, free trades, fractional shares, gamification. You can trade from your phone. It can create social disruption because you have to sort of enter this world of investing through traditionally it was through, you went to a bank and you talked to an advisor, and your advisor would, sort of give you some tips if you don't have a financial education. So my conclusion is that there has been a lot of over leveraging at individual level. When it comes to institutional investors, there has been a play for active ETFs. I think people have decided, okay, passive ETFs, maybe they're just follow the market can crash. So now we have more and more active ETFs. We have opaque ETFs that don't even have to disclose the portfolios. So I think active investment is trying to make sort of a resurgence. I don't think they have yet overperformed. Yeah.
Thank you so much. And the second question that we have is, do you believe that our economy is in a bubble regarding to the inflation of prices and the condition of the real estate market in Canada?
Okay, let's split this in two. Let's talk about inflation and about inflation is low, right? Inflation is negative.
Yes, absolutely.
Now there have been discussions, right? Because people see that the grocery bill is going up. So how can inflation be so low? And I think Bank of Canada recently, like a month ago, sort of decided to use a more forward-looking way of computing the price index. That sort of bumped up inflation a little bit, but it's still low. So I don't think we're in a bubble. I think demand for purchases, demand for credit is relatively low. People face a lot of uncertainty. They sort of stop consuming. They don't travel anymore. There's basically no entertainment. So in that sense, I don't think we face an inflation problem. Okay. That's why the central bank is so comfortable pushing this QE very strongly. They're trying to stimulate demand. In what concerns real estate, and here also we have a rental market, we have a purchase market, right? Rental prices in the core areas in downtown, they have gone down, right? A lot of buildings, a lot of landlords are offering 1 month free rent. Now, rental prices affect the cash flow, affect the actual value of condos. I think what we're going to see is a disconnect between condo prices and the detached market, right? With more people requiring more space, more people moving to the outskirts, we're going to see prices outside the major metropolitan areas, like think Mississauga, think Oakville, think Vaughan, they will go up, whereas prices downtown will go down.
Okay.
I mean, prices are at an all-time high, but so we don't have worse of a bubble than we had before.
Okay. All right. So the last question that we have from the survey is, what do you believe are prominent indicators that revealed loss of business confidence during March and April? Like, what were the prominent indicators that revealed that there was a confidence loss in the businesses during the first 2 periods of the pandemic, and when the markets were crashing?
What do you mean by loss of confidence in the businesses? Like the loss of confidence in their profitability?
I think that's what the person means. So basically, like, confidence in the running of the business, and how they're going to operate in those 2 months, because that was really hectic and it hit everyone like all of a sudden. It wasn't something that everyone was like being able to predict in their own lives. So how do you think, what were the prominent indicators for that?
I mean, if we're focusing on the first couple of months, right? The stock market is a good indicator, right? Because the market really crashed. I'm not sure if somebody can sort of get a measure of sales. Then again, the drop in inflation, right, signals that there's been a pushback in demand. The huge increase in unemployment, which we sort of we saw on the slide. So there are macro indicators, there are stock market indicators that have since gotten better.
Okay.
But that's essentially what I can think of.
Okay. Okay, that was all the questions from survey. And I actually had another question for you. So I was actually taking the course investments with you in the last semester, like in the winter break. So I had I had a chance to trade on the Rotman trading platform, and we had invested in the stocks of healthcare as well during that particular period, like in March, because that's when everyone was that's when we heard the news of everyone going to the stores and getting all of the cleaning supplies and everything.
Exactly.
Everyone's creating a panic. So do you think like that was like a herd like behavior in that particular month of March, which led to people, as the stock prices started to go down, it didn't go down like extremely in one day or something, but do you think like it was a herd like behavior of the investors in the market which led to such a plummet in the stock market, and that led to new growth in the healthcare sector stocks, because they did really quite well in those 2-3 months, like for like a short-term period of trading as compared to other stocks? The healthcare sector did actually do pretty well. So would you think that there was a herd-like behavior which like where investors switched from certain stocks that were in the market to healthcare stocks, and that's why the plummet happened for the other stocks in the market during that particular month?
I mean, I'm not exactly sure if I would call it a switch. There was definitely an element of herding, right? Because you get this bad news day after day, and you see the market going down. You want to be there before, you want to sell before it hits rock bottom. So there was definitely some herding, and that's why it sort of came back recently. Perhaps there would have been less of a herding in health. I doubt that people, or some of them might have like actively took money from other sectors, put them in health. I think like a lot of new investors, they say, hey, if anybody's come with a vaccine, then it's gonna be one of these companies. So I can invest in this type of portfolio. So maybe the herd effect would be attenuated.
Okay.
In health, but this is all that everything that happens right with like sales of I don't know, hand sanitizer and stuff. That in those first months, we felt like, okay, there's we have to get our hands on some of those, because there might not be any in a couple of weeks. What happened, and also what happened to companies, is that the supply sort of managed to adapt, right? Like we had like breweries and distilleries actually building the capacity or switching to producing this kind of stuff. And we had textile factories sort of readjusting to produce masks. And that's what we see in the corporate sector as well, right? Like many of the companies that were in a sense well positioned to readjust, they adjusted. I was reading yesterday an article about Airbnb and how essentially Airbnb tweaked their algorithms to not offer you vacations in the Caribbean, but to offer you vacations in a radius of 300 kilometers. So we shift from like, hey, why don't you go to a condo in London or somewhere far away, but go to a mansion somewhere within driving distance. So they had to do this. And the CEO said, well, I had to make 10 years worth of decisions about the algorithm in 10 weeks.
Wow. Okay.
So companies adapt, right? And that sort of gives us hope that, and that's what pushed the price up a bit.
Yeah. And what do you think is the future of, like, just talking about just the healthcare sector right now? Because there's a huge demand of masks still in Canada. Like I read an article where it says that there was a demand for like during the pandemic, there was a demand for 300 million masks in Canada, and out of which only like there's still a deficit of 100 million masks, which is like still left. Like the demand is still growing for the masks, and we don't have that much enough supply in Canada. So do you think like the healthcare sector, is it like a bubble that is gonna grow just for like let's say another year, and then people are gonna switch back to not wearing masks and like plummeting that particular sector? Or how is it gonna go? Like what do you think is the future of the healthcare sector in terms of stocks and like like the prices of it?
I mean, like there are different things that go in the healthcare sector. I think this kind of like production of like temporary things like masks, which actually are not only produced by healthcare companies. That will go down for sure.
Okay.
But I think that's my 2 cents. There could be more R&D. There could be like, okay, this pandemic passes, and we realize that the system has been chronically underfunded. We realize that we don't have enough hospitals. We realize that we don't have enough drugs. We realize that we don't have enough medical equipment. There was, if you look at, there was a show on Netflix about like inventions, and they were talking a year and a half ago about the universal flu vaccine.
Okay.
Right. If we had a universal flu vaccine in January or in March, this thing would have never come to pass. And this kind of R&D, right? We need better drugs that will sort of cover, right, the range of potential diseases. Like COVID is one particular virus, but there's so many other viruses out there in the wild that could emerge. So I don't think it will crash, right? The sort of the short-term production of things might slow down, might decrease, but there could be this realization that, hey, we didn't invest enough in healthcare. Imagine only what would happen if US, either under, I don't know, Biden administration, would say, hey, healthcare should be universal. Let's build hospital, let's build equipment. Because we cannot afford to have another crisis of this scale.
Okay. Thank you, Professor. That was actually helpful. And I don't think anyone else have any other questions. So I believe that will be a wrap up for this episode. If anyone has any questions, you can stay if Professor Zoikin has time and is allowed to do that. And otherwise, you all of you guys are free to go. And thank you for joining us and have a great day.
Thank you for having me.
Thank you.
Thank you.
Okay.
Thank you.
Thank you, Professor.
Okay.